Alright, welcome to my video on QYLD versus Jepi. These are both covered call ETFs with very high dividend yields. And generally speaking, I really like covered call ETFs when done right, because there's a huge difference between good covered call ETFs and bad ones. And this comparison serves as a great example of that. And spoiler, QYLD is the bad one. Before you dislike the video, I just want to say I do not have any prejudices one way or another. I invest to make money, so the total return is the most important thing to me. And after doing my research, I believe Jepi personally is the better investment. That's my opinion. And if we look at my portfolio, I invest in Jepi because that's the conclusion I came to. I think it's the better ETF. And as always, if you want to look at all my holdings, I will leave my portfolio linked down below. Okay, so let's take a deep dive into these ETFs and see how they function and how they give you that return. So Jepi, the basics, right now it has a dividend yield of 7.48%, and QYLD is more at 11.36%, so a very high dividend yield. And if we come over here, QYLD is based off of the NASDAQ 100 index. So when you look at the top 10 holdings, we have names like Apple, Microsoft, Amazon, which are all great companies, but I hope people don't look at this, see the great tech names they love, and then look at the 11.36% dividend yield and think this is the greatest investment ever, because it doesn't work the way you think. But more on the functionality in a second. In terms of popularity, Jepi is only like a year and like 4 months old, something like that, but it has 1.9 billion in assets under management, and QYLD is a little bit more at 3.4 billion. Although if we look at the daily fund flows, we can see that Jepi and QYLD are very similar. The y-axis is different on these, so once you take that into consideration, they're actually very similar. All right, but now let's get into the actual meat and potatoes here. And what I did is I went through their documents and I pulled out the most relative information to kind of make it more easy to digest. So let's go through Jepi first. So the fund seeks to provide the majority of the returns associated with the S&P 500 total return. So that's its benchmark. It's trying to keep pace with the total market while giving you higher levels of income and less volatility. Pretty cool. And the fund does this by creating a portfolio of equity securities and also investing in equity-linked notes, ELNs. So there's two methods. So if you move down a little bit further, I have a bit on each of the methods. So the fund invests significantly in the equity securities of companies included in the S&P 500 index, which is both large and mid-cap companies. Now, it doesn't give you an exact percentage of how many equities they have, but they say a significant portion is in equities. So we have that. And then the second part is those ELNs. So in order to generate income, the fund may invest up to 20% of net assets in ELNs. ELNs in which the fund invests are derivative instruments that are specifically designed to combine the economic characteristics of the S&P 500 index and written call options in a single note form. So the ELNs are just call options that are kind of wrapped into a fancy financial package called ELNs that have some special characteristics, but those are the call options that generate the income. And then coming over to QYLD now, QYLD seeks to provide investment results that correspond generally to the price and yield performance before fees and expenses of the CBOE NASDAQ 100 Buy Right V2 index. So what is that index? Well, I found this blurb way deep in the documents of QYLD, and it says the BXN index is a benchmark index that measures the performance of a theoretical portfolio that holds a portfolio of the stocks included in the NASDAQ 100 index and writes or sells a succession of 1 month at-the-money reference index covered call options. And then this down here does a great job summarizing what that all means. So each of the funds, which is referencing QYLD, XYLD, and RYLD, writes index calls to cover 100% of their portfolios with at-the-money strikes 1 month out. And it does that over and over again every single month. Very simple. So right there, a big distinction is the ELNs, which are kind of similar to the call options QYLD does. In Jepi, it's only 20%. And 80% is equities. In QYLD, it's 100% of the portfolio, and they're at the money strikes. They don't say if Jepi is at the money or what, But in my following example, I'm just going to assume for simplicity's sake that the ELNs are very similar to the call options in QYLD. Alright, so this is a mathematical example of how these funds operate. Let's begin with QYLD. I promise this is very simple, so just follow along and I'll do my best to explain it. So let's assume with both these ETFs, I'm beginning with QYLD first, you have $1,000 to invest and it's $10 per share, so you buy 100 shares. And then as we just saw, QYLD covers 100% of its index with covered calls. So they sell at the money calls, and for this example, let's say it's $1 per share, so you collect $100 in call premium. Then let's say at the end of the month, the stock or the index went up 10%. So now the market value of those shares is $11 per share, and the strike price, because it was at the money when you bought it, is $10. And index calls work a little bit differently. So instead of the shares getting called away at $10 a pop, it's simply settled with cash. So in this case, you pay that difference, which is $1 times 100 shares. So you have to pay $100 to settle that difference. So if you recall, you only collected $100 in premiums. You lost or paid out $100. So during this period, there is no gain or loss. So you still have $100 with these numbers. Now let's move on to Jepi, and I'm going to keep it all exactly the same. So you invest $1,000, $10 per share. But keep in mind, Jepi is a hybrid ETF. So 80% is equities. So out of the $1,000, $800 is just invested in stocks. Then the other 20% is those ELNs, so they sell at the money calls for that same $1 premium, so you collect $20 in option premiums. Then let's say the stock price goes up 10% again. Because 80% of this is equities, that just goes up 10% with the market. So now you have $880. Then for the ELNs, the strike price was at the money, so $10. The market value is now $11. So that's a difference of $1 times 20 shares is $20. So just like before, the $20 you collected in premiums and the $20 you have to settle with cash payments cancel each other out. So at the end of all this, you have now $880 because of the equity, plus the same $200. So that gives you a final value of $1,080, which outperformed QYLD, which gave you no change at all. So the point I want to drive home here is that QYLD, because 100% of the portfolio is at the money covered calls, there's no price appreciation whatsoever. 100% of the gain or loss is based off of premiums collected. And this right here does a great job explaining when you make money with premiums and when you don't. So profit or loss on the option is the difference between the premium received and the change in asset price up to the full premium. If those gains are greater than the premium received, that is a loss. If the underlying asset takes a loss that exceeds the value of the premium, the call seller participates in that loss to the extent it exceeds the premium. All right, now let me try to put what I just read into a visual format because it's really basic, and once it clicks, it's super easy. So if you sell covered calls on an asset, say the premium you collect is $5 per share, then the stock price represented by this white line here in the middle, this is no change, right? So flat means that for this whole month, the stock price didn't do anything, but you collected $5 in premiums. So the ideal scenario is nothing happens. The stock goes sideways and you collect that $5 in premiums. Now, if the stock goes either up or down, it's the same thing. Let's say $2.50 during that time, that is subtracted from your premiums. So that means at the end of the day, you only have $2.50 of option premiums. And the worst case scenario is that the stock price goes either up or down more than your premium. So if the stock price goes up $6, you have a $1 loss. And that's whether it goes up or goes down. And then down here is the final thing I want to talk about, and this is the total return chart. Jepi is in blue, QYLD is in green, and the S&P 500 is in yellow. And Jepi is definitely outperforming QYLD, and if you recall, the goal of Jepi is to have most of the returns of the general market, which I think is a very noble cause while having less volatility and higher payouts. And QYLD is definitely falling behind. I feel like a lot of people invest in QYLD simply because of the super high dividend yield. But that's usually the definition of a yield trap, chasing the highest yield possible. And I think I did a good job explaining why it's really not a great long-term strategy. It's too extreme. It's 100% on those option premiums, and it has been pretty successful so far. But if we come back to this, it's a very narrow range where you can actually make money, and you don't have any equity in the underlying companies that you quote unquote own. That's the reference point that the options are based off of, but it's all option income. And in the long run, I think you're going to be better off having equity and ownership in these great companies. And that's what Jepi offers, along with those financial derivatives, ELNs, to offer more of a payout along the way. So the hybrid nature of Jepi is way more appealing to me than QYLD, which is rinse and repeat, same thing every month. And it has been working pretty good so far, but there's no guarantee that's going to continue into the future. And if it begins to fail, they're going to have to cut the dividend payments quite significantly. But that's the end of the video. I hope you guys enjoyed. If you're still watching, give the video a like, subscribe to the channel, all that fun stuff. And I will see you in the next one.